Well, hello there, everyone. Chris Karam here, Chief Investment Officer with Finspire, here for the third quarter Focus on the Markets Hot Summer Edition. We know the temperature is rising in this summer. You know, it's been a hot summer here in the Midwest. We also know that temperature has been rising fast in Washington, D.C. and in the investment markets. So whether you're traveling this summer by air, sea, car, bike, maybe even horse-drawn carriage, just hold that thought till the very end. Where will the markets take us in the second half of this year, especially as we put a bow on the first half of 2025? So let's get right to it. As usual, we're going to share our opinions on the markets after reviewing some of the factual events that have occurred, especially in the first half of the year. Let's hit the capital markets strategy board. What are you going to do? What are the portfolio and investment implications of things happening in the economy? Yes, we had a negative GDP report in the first quarter. Will that hold? Not likely, but it was negative, and I'll show you the impact tariffs have on the anticipated tariffs that have occurred inside the GDP report from the first quarter. The second quarter GDP report will be coming out very soon. All right, markets. Markets were the story. They surged. The S&P 500 surged after dropping 19% from peak to trough from mid-February to mid-April, and then a really strong V-shaped response. The rest of April, all of May, and June were very strong months for the for the equity markets, primarily for the U.S. large cap and also the overseas equity markets. Small caps trailed. We'll get into that, and also look at some of the diversifying asset classes that actually held up very well this year. Fixed income, precious metals like gold and silver have all been additive to diversified portfolios. And then politics. We haven't seen in my adult life the movement of Washington, D.C. as quickly as it's occurred in this legislative session. Narrow majorities by the Republicans in the House and Senate has actually translated into rapid-like speed in legislation. And so the tax bill, the proposed legislation that included things like tax rates remaining the same, border spending, defense spending, and also Medicaid reforms were all baked into a large bill that was signed by the president on July 4th. Signature piece of legislation. We'll talk about the investment implications that has along the way, as well as efforts in global peace, which is advancing in certain areas and elusive in others. And we'll talk about the investment implications of being in a diversified portfolio, which is incredibly important in a year like 2025. All right, let's look at that GDP report. All right, I mentioned that, yes, we were negative. In fact, negative 0.5% was the GDP reading in the first quarter of 2025. But what's fascinating about this report is that we can already see the impact. And this was the first quarter prior to the additional tariffs that were layered on April 2nd, the announcement on April 2nd. You can see the impact that potential or proposed or anticipated tariffs we're already having in the U.S. economy in the first quarter of the year. Check this out. Gross private domestic investment up, hasn't been up that high. You can see in the last couple of years. Net exports, meaning that imports greatly exceeded exports in the first quarter. Net exports were a drag on GDP by 4.6%. So you can already see the impact. What does this mean? That means that when you apply tariffs, when a country traditionally applies tariffs, it protects or in sense domestic investment, which is what happened, but it also incents those who are considering an imported purchase to advance that purchase into the first quarter in anticipation of higher tariff rates down the road. So you get a lot baked into this 0.5% negative GDP report in the first quarter, not likely to extend itself into recession territory, primarily because unemployment has been really low, and it clocked in at 4.1% at the end of June. So recession really is low or on the decline. All right, so let's look at the equity markets. Look at the global investment markets, I should say, altogether. Here, you've gotten accustomed to this chart. The S&P 500 in red, 15 years of history. 6.2% positive was the result as at the end of June 30th for the first half of the year in the S&P 500. That is incredible, given that was negative 4.5% or plus or minus in the first quarter of the year. So you can see the equity markets really surged especially in that second half of the second quarter. But you can see this is the year for diversification. International equities, developed markets up 20%, emerging markets up 16%, and a balanced portfolio somewhere in the neighborhood of 6.8%. And that's because fixed income, which has been kind of a drag on overall returns, has been a nice additive, positive contributor to results. Fixed income measured by the Barclays Aggregate Bond Index, Bloomberg Aggregate Bond Index, I should say, up 4% in the first half of the year. Now, it's not always about the U.S., and certainly this year is in that case. If you look at the developed market, if maybe you're traveling to Greece this summer, it seems like everybody's traveling to Greece or Italy or something like that. But Greece is the number one performing developed market stock market in the world. So almost 59% as of July 4th. And then the number one emerging market country in market performance is actually Colombia. Down here, this is the Colombian flag at almost 49%, 48.6% return in the Colombian stock exchange. So you can see there are returns to be had. It's a good year to be diversified because return generation is accessible all over the globe. I mentioned this pullback. Markets, the equity market measured by the S&P 500 pulled back 19% from February 19th to April 8th. That's a big pullback, but that's also not uncommon. Now, this chart we haven't looked at in a while, primarily because we didn't have big pullbacks in 2023 and 2024. But if you look at this 45-year or so plus history of the equity markets, the red dots represent the biggest drawdown occurred in that calendar year, and the blue bar represents the actual return for the full calendar year. So within the year, it's very common to see these red dots or negative returns from peak to trough, and in some cases in double digits. And in our case this year, it was 19% in the U.S., only for it to be still positive year to date. These can happen. Pullbacks happen, and it's important. So I put a few fun places to visit this summer. On the top right here is Cedar Point. So if ever you've been to Cedar Point, Sandusky, Ohio, I used to go all the time growing up in Southeast Michigan. It was an easy ride over to Cedar Point. They have the best roller coasters ever. And so this is the main roller coaster at Cedar Point. Or maybe you're a different kind of thrill seeker, and maybe these undulations in the equity market returns maybe will inspire you to run the Leadville 100. That's at the bottom here of this, bottom right of this page. I actually had the privilege of accompanying my brother-in-law 1 year to the Leadville 100. That is a race. It's known as the Race Across the Sky in Leadville, Colorado, where you actually start at 10,200 feet and you climb to 12,600 feet up a mountain slope, and then you come back down for the other 50. The first 50 miles is uphill, up at elevation by 2,000 feet. Then you got to come down 2,000 feet in the second 50 miles. If it sounds crazy, it is, but it's pretty darn cool to watch. So maybe your travels will take you there this summer. All right, I mentioned the V-shaped recovery of the equity markets. We always have to be cognizant that are the markets getting ahead of themselves? I would argue yes, that happens all the time, especially in the short run. Markets get ahead of themselves on the upside. They also get ahead of themselves on the downside. So that's what we saw a little bit both in the first half of the year, where the market was a little bit elevated in price, where we were reflecting on those prices for markets to come lower. And then markets got a little too pessimistic based on the tariff news, and there was some excessive pessimism in the markets based on the earnings that the S&P 500 companies were generating. And now, as you can see here, this really quick, short V-shaped recovery here, we might be a little ahead of ourselves again, awaiting earnings from those same S&P 500 companies. Now, as we've looked at this chart in the past, the movement of the S&P 500 is the blue jagged line. The earnings mountain is in the blue background. So whenever prices get too far ahead of earnings, that's when we know we're a little bit too expensive in the markets. When those prices are well below the blue earnings backdrop, then that's when we know markets have a good chance to rally in the longer term. So 78%. Why did I choose 78% here? According to FactSet, 78% S&P 500 companies beat earnings estimates in the first quarter. Off to a pretty reasonable start here in the second quarter, but those are just filing in as we speak. So if you're looking to translate that into a summer travel plan, down here at the bottom right, that's Montpelier, Vermont. Beautiful place. I haven't been there, but I'd like to go someday. Why did I pick Montpelier? Because the average temperature in the month of July in Montpelier is 78 degrees. So this is our chart for 78. If you're looking for a nice, cool summer destination, maybe Montpelier is in your future. All right, let's talk more about these earnings and valuations because they present opportunities across the investment landscape. I mentioned earlier that small caps continue to trail large companies by a significant portion. That's been the case for several years. And whenever you get several years of, let's call it distorted returns, especially across capitalization, large cap to small, you start to get charts that look like this. Okay, so we've looked at this before. However, you have bars and you have diamonds. And the high bars represent earnings growth. The diamonds represent the ratio of prices relative to the earnings generated. So if you're looking for investment opportunities, you want to find things that have high bars for earnings potential, earnings growth potential, and low diamonds for low valuations. That would be the best mix, historically speaking. So in this case, you can see large cap growth. I'll just pick on large cap growth here, which has a lot of technology companies in it. It has pretty good earnings growth, but you can see the price you pay for that earnings growth is pretty high relative to small companies, small company value stocks. If you look at small companies, they have actually pretty high earnings per share growth estimates, and they have very low valuations in contrast to large cap growth. So this is when this can happen over time, where things don't correct themselves over the short term. They tend to wait till a catalyst is involved to trigger change in market attitudes towards, in this case, small caps over large caps. So on the top right there, small caps are those salmon swimming upstream. They have been for the last couple of years trying to catch up with their large cap growth brethren. On the bottom right, however, is beautiful. Do you know your way to San Jose, California? San Jose happens to be home to Adobe, eBay, Cisco, Zscaler, and other large technology companies that, hey, if they continue to perform and continue to deliver on the earnings front, the momentum towards large cap stocks could continue in favor of small caps, but eventually over longer periods of time, especially as the economy resets post-tariff deals, you could see a wave, maybe a little bit of a wave, more favoritism towards small caps over large, but it hasn't been that way yet. All right, I told you we're going to talk a little bit about currencies and why this is important. So I'm showing you currencies' performance relative to one another. So in other words, the US dollar versus the Great British Pound versus the Euro and other currencies. On this visual, if they both had the same value, if they both started with the same value back in 2023, you can see over the last couple years how they've diverged. You can see the dollar index has fallen, which means that other currencies are strengthening. So in this case, the Great British Pound. So I have a nice, beautiful lawn tennis court here for Wimbledon, to resemble Wimbledon here. If you ever had a chance to get to Wimbledon, I'd love to pick your brain about that. It's on my bucket list of things to do. But the Great British Pound has benefited significantly. The value of the Great British Pound has benefited significantly relative to the dollar so far, especially in 2025, post-tariff announcement in particular. And you can see things like Japanese yen. This is Mount Fuji at the bottom right. If you're interested in ever traveling to Japan, you can see Mount Fuji. The yen has sort of stayed level in its value relative to the US dollar, even though the dollar has declined over time. What this means is, as international currencies strengthen relative to the dollar, and international companies, for we as U.S. investors, when those earnings get translated back into U.S. dollars, it simply means they can buy more U.S. dollars with those earnings. What does that mean for us as U.S. investors? The value of our overseas investments goes higher. And that's why you've seen such a big outperformance. One of the reasons why you've seen big outperformance of international stocks relative to the U.S. so far in 2025. This is an important story. We're going to keep following it and keep getting you information on it because it does have significant investment implications. All right. Speaking of investment implications and a hot summer, it is really hot at the Federal Reserve. The President Trump and the chairman of the Federal Reserve, Jay Powell, are at it. It seems to be Trump is badgering him quite a bit about a variety of things, but primarily around keeping short-term interest rates at the current level. Trump doesn't like it. Jay Powell and the Board of Governors at the Federal Reserve have stated that they're not interested in aggressively cutting rates until they see all of the tariff implications ripple through the economy. Well, this is causing an enormous amount of consternation. So I have, so you can see here short-term rates with the Federal Reserve over here. You can see other short-term rates controlled by the markets. The markets clearly think that short-term rates should be lower because the 2-year bond is hovering around 3.72%. You can see the 10-year note is still hovering around 4.25%. It's been between 4 and really predominantly between 4.5%, really between 4.25% and 4.5% for the last few months, with some outliers, especially that transpired after the tariff announcements on April 2nd. But this is coming under intense scrutiny because the U.S. is trying to refinance $36 trillion of debt, and they're doing that at today's rates versus where they were 5 years ago, which were much, much lower post-COVID. And so the cost to rebalance and refinance pressure here to see lower rates across the board. So there's a big convention every summer in Jackson Hole, Wyoming. So if you look at this bison here at the bottom right, this bison is enjoying himself in Jackson Hole, in the Jackson Hole area. The Federal Reserve will be having their annual retreat in July and will be making announcements later this month. And those announcements could have significant investment implications as it relates to how they're going about interest rate cuts in the second half of the year, if at all, and it will move markets. Okay, I mentioned that the Federal Reserve is it's hot in the Federal Reserve. It's also getting hot in Congress. Why? Part of the tax and spend package that went through late June into early July and signed by President Trump included 1.6 trillion of spending cuts. That is essentially a starting point where the politicians are really looking at this curve, and it makes them very terrified because they see that if we stay on the same trajectory of deficit spending and debt accumulation, the interest paid on that debt is just going to balloon over the next several years, was what you see here in this dotted line, moving forward. You can already see that interest payments on the debt have been starting to rise parabolically, and you can see that rise, that curve. There's a phrase that's used a lot, especially in politics. It's called bending the curve. This curve needs to be bent, and so otherwise, it's just going to consume our federal deficit spending in our overall budget on a year-to-year basis. So for the first time in my adult lifetime, the debt and the deficits really matter because they're actually having investment implications. The more debt, the more deficits that we have, the higher interest rates remain stubbornly high, and it's much harder for those rates to come lower. So this has massive implications, political implications, as well as being a major risk to the equity markets and the bond markets. So what you see here, Denver, Colorado, one of the largest U.S. mints is in Denver, Colorado, printing money along the way to keep up with all those deficits that we're running. But this is a significant story that's going to unfold further as we get into the second half of the year. This also translates into interesting non-dollar, perhaps non-U.S. dollar investments, things like gold. Gold, which has been around for millennia in terms of being used as a currency, as an exchange of value. You can see gold has really in 2020 started not only stabilizing but picking up steam in attraction because our deficits ballooned, and gold has been there as a that stores value for investors. And you can see at one point during the April downturn in the S&P 500, right about here at this peak, the value of gold, after being so mismatched to the market for 5 years, to the equity markets for 5 years, actually caught up to the value of the market earlier this year. So really fascinating. There's some other, what we'll call non-dollar type things happening in the areas of cryptocurrency. That has also been making its way in a regulatory framework through Washington, D.C. We don't have time to talk about that today, but that's going to be a good one for the next video. If you look at the charts on the video, or the pictures on the right, yes, this is the Great Wall of China on the top right. Did you know that China is the largest miner of gold in the world? Over 10% of the world's gold is mined in China. And silver, which has also been a long time utensil for currency and trading over the years. The largest amount of silver in the world is produced and mined in Mexico. So this is Chichen Itza, one of the most popular visitor destinations, vacation destinations, and tourist attractions in Mexico. So there are a lot of implications here as it relates to gold and silver and all those other asset classes that we talked about today. wherever your travels take you, we want to wish you a happy and adventuresome trip. Sometimes those popular family vacations are always the ones that don't exactly go according to plan, but we know we've been there. This year, I mentioned at the start that whether you're traveling by air, sea, land, car, or even by horse and buggy, I have to tell you, I took my wife, I'm a Michigan native, I took my wife to Mackinac Island this summer just for a couple days to get away, and it's pretty. So the top right there is a picture of Mackinac. We did the bike ride at the bottom there, about 8.2 miles around the island. A lot of fun, but you can only get around the island in horse-drawn carriages. Now, as bad as you think things might become, whether it's in Washington, D.C. or in the markets, I don't think we're going back to the horse and buggy, but it was kind of cool to go back to that way of life for a couple days as we took our adventure into northern Michigan. Stay safe, everybody. Hope you have a great rest of the summer. Enjoy it, and we'll talk to you soon.